private equity style performance. That is to say, above market returns with muted drawdown. So if that crash comes, you won't get hit too hard, and modest correlation with stocks markets. If they can do it, it would be incredibly useful, both for people who can't access PE, who will now have the ability to access something that performs like PE, and for people who can access PE as a tool in their toolbox, not to replace their PE, but as something helpful to use around the edges. So hopefully I persuaded you of that. Now I have to convince you that we can actually do it. So the question is, how the heck do you get private equity style returns in liquid markets? Okay, and here's the idea. We have the data on what private equity holds. There are about 1,000 LBO funds in America that matter, and we know what is in those funds. 8,000 private positions, we've got the data on them. So we're going to use that data to create a portfolio of hundreds of public companies that match the characteristics of those private companies, okay? And then we're going to buy those public companies. So buy what they buy, step one. Lever like they lever. When we say private equity, we are focused on the leverage buyout business, the classic buyout business developed by Warburg Pincus and KKR and Clayton Dubilier and Rice and so forth. Someday we may have liquid venture capital, liquid real estate, and other things. Right now, you have to start somewhere. We're starting with the core, the heart of private equity, which is LBO. Okay, and that L stands for leverage. The good news is they're not that levered. Levering 1.3 to 1.5x is all it takes to match the leverage that's in those LBO portfolios. And so that's what we do. Okay, and then finally, protect the downside. Okay, and that's where we get to Marty's crucial question, right? What can we expect from private markets if we get those rising rates? Well, those private companies obviously are expected to deliver cash flows for a long time, right? And those cash flows, if they get discounted at higher rates because interest rates are up, they have less value. Look at what happened in 2020, right? The market crashed and then it came back super strong. And why did it come back so strong? Because of the Federal Reserve. The Federal Reserve said, this will not stand. We are cutting rates. If you think back to your discounted cash flow, I used to teach intro finance and I love it. If you think back to your discounted cash flow formula, where you take all those future cash flows and discount them back to today at 1 plus the discount rate to the 20th power, the 25th power, the 30th power, depending on how far away it is. Boy, if you subtract 1% from those interest rates, those cash flows are far, far more valuable. And that's why we saw the value of both public and private markets rocket in response to that Fed action. Now, if it goes the other way, it's going to hit both public and private markets. Now, what makes private markets so attractive and LBO so attractive is they have a tendency not to mark the positions down very much. Again, go back to the first quarter of 2020 when COVID hit, right? Stock market was down 20%, okay? And if anything, the kinds of companies private equity holds were down more because what they hold are what we call LBO-able companies. Those are the kinds of companies that can afford to pay the interest on a leveraged buyout. Remember, on a leveraged buyout, you borrow 3/4 of the money